Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with Zach Oehlman. How you doing today, Zach?
I'm loving life, Kirk. Thanks for having me on, man.
Good. Well, glad to have you on the show. And before we begin, Zach, maybe you can tell the listeners a little bit about your background.
Yeah, so I'm grew up in a small farming community in Indiana, and had big visions of traveling the world, making money, and helping people. And someone told me, you need to become an investor, business owner, and had no idea what that was. Went to college, graduated from Indiana University with a degree in finance and business in 2008. And if anyone remembers that, it was not a good time to be in any industry, let alone finance. But I got a job working down at the Chicago Board of Trade, did that for a little bit, and then I went on and became a valuation analyst. Pretty much have valued anything that can create a cash flow, specialized in illiquid, off-market assets, uh, software, human capital, things like that. And then took that knowledge and started my own business. And so today we run a couple different businesses. We have like a private equity model where we come in and we help businesses grow for a piece of the company, and all about just helping other people learn about what we do and about how to make money inside of business. So that's what we spend our time doing.
Nice, nice. So I'm curious, how was your experience in the CBOE?
It was it's like I got to see behind the proverbial cloak, and I didn't enjoy it, to be all honest. I the reason I got into finance was I got to see all my friends were blue collar guys. My dad was a CPA, and I wanted to help. I wanted to understand money and help people make better decisions about it. And I thought that was going to be an opportunity to do that there. And what I learned was, man, if you're not producing, you're a nobody. That was sort of the, doesn't matter how much you knew, it doesn't matter that. And I just really didn't like the firm that I was at. So I quit that to go into consulting. And so it was an interesting point of view from where I was standing.
Yeah. No, it's interesting. Definitely an interesting time period for sure. So why valuation? Why did you decide to go into valuation? That doesn't seem like a sexy field.
I wanted to buy businesses. I wanted to be hedge fund type stuff, private equity type profession, and I knew nobody. I didn't have a network. I wasn't a social person. I was, in fact, socially awkward. It was, I was an analyst because I was really good with numbers because, I didn't have to talk to people. And so I figured, hey, if I become really good at understanding business, what makes business grow, I mean, I'm a financial modeling, three income statements. Like I can conceptualize the stuff today because I spent so much time doing it. And I said, okay, if I can learn that, then I can learn how to grow and scale businesses. And so we took that and bought a business and actually put it into practical use. And they were doing that today on a much grander scale.
Nice. So, I can certainly see the attraction of the of numbers over people because numbers don't lie. But but like, when it comes to businesses, I mean, obviously businesses, you could look at it from a clinical standpoint and say, all right, this is a good valuation, but there's a good amount of people and the human capital that goes into business. So how do you kind of look at those two, and kind of square that?
Well, I had like this revelation when I was because all I did was study and read. And I was like, humans create the numbers that I use, because you have some people, they're all about the numbers. And so I took it a step further. I was like, well, where do the numbers, how are they derived? And they're derived by human making decisions. And so, on the front side of, projections, we look at all of that into account from the actual revenue expense side. But then from the human capital of what it takes to run and maintain a business, there's two different sides of that. And I've learned, like, you can have the best systems and processes in the world, but if the people of your company aren't inspired, man, you're not going to be around very long. And so I spend a lot of my time developing my internal team, and so that, they're proud to be offering whatever it is that we offer, so we can manage both the numbers and the human side of business.
So do you have a team that works with the same team that works with each company, or are you developing different teams for different companies?
Yeah, so what I've done is I have a sales, I have a marketing team, I have an IT team, and so they're all internal. And so what I was doing as I was growing and scaling my businesses was I was outsourcing everything. And what I found was when it didn't go as planned, everyone was pointing the finger to somebody else. And so I said, you know what, I'm just going to build my own internal team. So we have internal IT team, internal software developers. We have our own CRM that we use in every business. That way, we use the same meeting structures, the same process and structures in every business. And so that way I can use the same team members, and it's like fractionalized, right? So I can get in at a much lower cost than anyone. I don't say anyone, but most other people, because I'm using, the same people across 6 companies as opposed to one person per company.
And that's a really interesting way to look at it. And I wonder, is that something that you know, are you able to do that? I mean, if you got like, 6 or 10 companies and you have one marketing team, I would imagine they're going to be pretty busy with one company, nonetheless 6.
Well, yeah, and so what we've done is I have a marketing company that scales with me, right? And so it's like I have if I ne- I have a VA recruiting and business development company. And so one of the challenges is when I was doing everything myself was finding help. I would spend all my time finding help, and then they wouldn't stick around, or I have to go find more help. And so I just started a VA recruiting, and a lot of my people are overseas. I'm actually coming live from Thailand right now, and so it's afforded me the flexibility to travel. And I've just found there's so much top talent around the world that, are used to working in fractionalized teams, and it's easy to scale uh, at that level. And so I don't have a lot of overhead. And then, there's specific positions I only use inside of, say the United States, based on just, client interfacing type stuff, where they want to see somebody, or they want to hear somebody that they are, can relate to.
Okay. So now let's talk more on the kind of the investing side here. So if you're looking at um, investing in a business, how do you go about that? What's your process in determining, all right, I want to invest in this business versus this other business?
So I look at everything I look at is marketing. I was like, what's the story? Can I pitch the story? Because if I don't believe in it, man, it's like it's hard for me to grow the business. And so the businesses that I like are like one of the businesses we're doing right now is a brain training program. It's a course that I took on how to memorize stuff forever, on how to become more effective and efficient in your day-to-day life by learning how to learn. And it was something I was really passionate about. And I talked to the guy, the owner, became friends with him. He was somebody that has top talent, like just an amazing service product, but he doesn't have the finances to, hire a team like me. And so he gave me equity, right, for that. And it's something I believe in. It's something I'm a product of. And so I have no problem, you know, selling it to my team to sell it. And so I look for companies that I really believe in and that are really making a difference in the world. Something I can get behind, both, and then rile the clients up, rile the customers up about something inspiring. And if I can't do that, it's just like I can't see a way for me to get behind it.
So are you now are you looking for different types of companies, like product based companies or services, or how do you distinguish, like, how do you narrow down the field from like 10,000 to like a handful?
So I love services. And so my idea is I can outperform anyone on customer service. Um, not there's a lot of great people out there, but like in the financial markets, like, obviously you have outperformed the majority of people out there, and it's because of your knowledge base, and it's because of the level of service you provide. and I tell people is like, if you can just do what you say you're going to do, you're going to outperform most people. And so, we have a couple different service companies that everything we do is service, and it's all about just providing a great customer service at a great value. I don't want to be the bottom of the barrel cheap, but I tend to go for more of the high end uh, clientele with a higher end price, and I'd rather deal on that end of the market and provide 5-star service than try to give everything away.
Okay. All right. So that, I mean, that's definitely, a segment. So that's great. So
Yeah.
do you have certain type of service businesses like accounting, or like what kind of service business are you looking at?
So, right now education is a big one. Another one is life insurance, because, there's a lot of agents out there, and it's sales and marketing, right? And everyone's competing for the same person. So I'm like, well, how can we deliver a better experience? So we're doing something in life insurance. We're doing marketing, sales and marketing, where we actually help people build out their sales team, their marketing infrastructure, be it SEO, paid ads, um, and just the whole the whole. I call it the whole picture. We help people with that as well, because a lot of the people I see when they're scaling a business or trying to scale a business is, if you talk to a website guy, your problem is your website. If you talk to an ads guy, the problem is your ads. And so, we have everything in house, and so I can look at something and go, okay, hey, I start with finance, right? If your finances aren't in order, it's going to be hard to predict, the future. And then I look at operations, if your operations, and then I look at sales, and the last one that we do is marketing, because I can flood people with clients and prospects, but if the rest of the stuff isn't on point, it's a waste of resources. And so we take a methodical process like that, and all the stuff we look at, and just, I don't want to provide ad services to people that don't have their finances in order, because they're probably not going to be around for long.
Yeah.
So
Okay. So now, getting back to valuation, you're looking at service businesses. Um, how are you looking at valuating companies? Like, what do you look for? Like, what makes the company attractive from a valuation standpoint?
and so I look for value add, and what I mean by that is people that have like a nice book of business and some systems and processes in place, but not maximized, right? Not let's say, like, we bought a company, and they were using antiquated software, right? And so we came in and we put a new software, a one-stop package that ran the whole company, as opposed to like 4 fragmented ones in a bunch of paper, right? And so I look for, where can I add value? I look for goodwill. Where's the goodwill at? Is the goodwill in the head of the company that is, and then if it is, how do we phase that out? Like, how do we stair step that back over, say, 3 to 5 years? Or does he keep his name on the letterhead? Or, there's all of these ways to transfer that value from the buyer to the seller. And so those are all things that I look at. And the big one is how can I where can I make improvements to the processes and the systems? And then are their customers going to stay with me when we potentially buy it, or after we buy it?
Right. But I mean, in terms of a practical standpoint, I mean, from a numbers perspective, like, how are you
Oh,
looking at valuating
oh,
small
got it.
companies, right? Because you're not looking at,
So
the annual reports. You're looking at something different.
yeah, and so I do 5-year discounted cash flow models on a monthly basis. Is that the type of answer you're looking at? Like,
Yeah, just like how you do. Yeah, just like getting into weeds, like
yeah,
how you're looking at private companies. What do you look at? Sometimes the numbers are messy, like all that stuff.
yeah, man. So I have a background in forensic accounting, and so when I was doing a lot of business valuations, a lot of it was shareholder disputes. I'm suing you because you embezzled some money, or you did something, or a husband and wife are getting divorced and they own a big company. And so there's always, there's always fun accounting tricks that people can do and use. And so I have a pretty good nose when it comes to sniffing out the numbers. But the most important thing is starting with a clean slate. And so I've created financial statements from bank accounts, and I started all the way back there because I had to, because I didn't have anything else. And so, if you can get the financial statements, obviously income, cash flow, and balance sheet, those and they're audited, those are great. But what we do is we normalize. We'll take a historical 3 to 5 year income statement and financial statements, and we'll normalize everything out. And what I mean by that is, the the vacations, the stuff that typically wouldn't be in a business, but the owner puts through anyways, just for tax purposes or whatever purposes. And so we can actually get a sense of the operating effectiveness of the company. And then what we do is we project them out. I like doing monthly projections for 5 years, and then we do scenario analysis and just get a sense of risk by running different scenarios.
Okay. Now, do you find that it's easy to do with private companies, or because
It's
I mean, a lot of the business owners, they're running it like it's their piggy bank. They don't.
it's incredibly hard if you don't know what you're doing, right? It's like trying to find a needle in a haystack. And then, most, oh my gosh, like the bookkeeping process of small businesses, it doesn't exist almost. And so you really got to know what you're doing. And I talk to CPAs that do people's books, and they don't understand it from an operational standpoint of value, right? They're just, more of a bookkeeper. So you got to really have a good CPA in there too that understands all of that. And then, you deal in your world of, the 401ks and the IRAs, and what's what's the impact of that. And it's complex in nature. And it's fun, but yeah, it's like a needle in a haystack.
So how do you kind of weed through that then? Like, are there certain size businesses that you look at, or like, how are you kind of weeding through? They just give you your bank account, give them their bank accounts, and you kind of figure it out, or how does that work?
Typically, when I first started, I was buying companies that were, doing a couple $100,000 a year. And so there wasn't a whole lot to go off of. And, the less information they have, the more flexibility I have for creative financing, seller financing. Because, I can look at something and I say, okay, hey, if your numbers are what you say they are, you won't mind carrying this back with a performance guarantee or something. And so you can use that to your benefit. Today, I like more established businesses, people that have a team, because that's one of the things I've learned over the years is like building your own team is tough. You got to weed through the good ones or the bad ones to get to the great ones. And so I'd rather buy a business with personnel and staff, with systems in place, with processes in place, and then tweak them as long as they're going in the right direction. And so that's what we look for today.
Okay, cool. Now, when you're looking at businesses, do you have? I assume that's different now. You're not looking at business with a few 100,000 in revenue, right? Are you looking for bigger businesses now?
Yeah, and so it depends. Like the one business that we're partnering with right now in Italy, they have 60,000 5-star reviews, right? They're super well known in Italy. In America, he owns the entire franchise. He did a couple $100,000 last year. And so I look at that and I go, okay, I can put it online. It's an online course. There's almost zero infrastructure in the back end from a human side, right? You get a couple assistants that run the FAQs and just make sure people get what they need. And your only limit is how fast you can sell this stuff. because it's proven that people love it. And so I look at that, and that has a small income, but has huge opportunity because it's proven in other countries. Now, if he didn't have something unique, I would have never have looked at the business, but he has intellectual property rights on it. Like, it can't be created anywhere else. And so that I see tons of value in that. If he was a guy that owns a paint shop and has no, strategic value, I wouldn't be interested in it.
So, that, as I'm kind of looking at this, so for a small business, right, some of the challenges is that they're not looking to get like seed rounds, and they're not looking to grow exponentially. So what is your goal? Are you looking to get an exit? Are you looking for cash flow? Like what's your exit strategy with a lot of these companies?
It's cash flow. And so I'm a realist. I started real estate. That's how I got into the industry and was able to quit my job. And I look at the risk profile of real estate, and I love it, but it's also there's an active and a passive way to do it, right? And so the active way, in my opinion, is just a business. It's like you're in the business of real estate. And the passive side of it is, you buy real estate for the passive, more investor side. And so I needed some active income. And I said, okay, fix and flipping is fun, but I don't like the risk profile. I can have a business over here where I can make $300 a month, which people are making on a rental property, by selling one item, two items, three items, and I have zero at risk other than, the skill set I had to acquire to gain that. And so what we do today is we make our active income in our businesses, and then we reinvest that into passive real estate.
Okay. So you're looking to funnel it from one place to another, really.
Right. Instead of going and fix and flipping or wholesaling real estate to make money, I'm just using businesses, a business model to do it. Put management in place, move on to the next one, and make sure the tracking and obviously everything's on point, and so that we can move on to the next one.
So I know with real estate, a lot of people have been able to scale, right? Because, efficiencies in real estate is relatively simple. It is a business, but it's relatively simple. And a lot of people have been able to scale to quite large portfolios. But I would imagine with businesses, it's a lot more complicated. There's a lot more nuance. There's a lot more in the weeds problems. It's not always simple because you're dealing with people. So how do you scale that? Like, do you have limits on how many businesses you work with, or how does that look?
I feel it out at the time. Like right now, we're working with 5 businesses, right? And I don't want to really take on any more than that because I have an equity stake in all of them. And so but I'm using the same process, the same structure, the same people on all of them. And we hired on new people for the entry level type stuff. And so I don't want to expand. I'd rather grow those 5 into something great than take on another 5 and all of them be mediocre. And so one of the things that we're looking on at now is bringing in directors of operations, right? And so the idea is systematize everything, document everything. I mean, we everything we do is we have flow charts, and so the idea is if our talent leaves, our knowledge doesn't, right? The intellectual property, the just knowing how to do business, and so we have everything documented, and then bringing in people to actually run these businesses. So I'm not running businesses. I'm more of the shareholder directing my team, and so that's what the vision is for the next for 2023 right now.
Okay, cool. Oh, that's interesting. So now, in terms of valuation, a lot of investors are kind of looking at like, hey, should I buy private company versus just like public stock? Are the principles the same, in terms of valuing a public stock versus private stock, or What can people learn from this that are looking to invest in public stocks?
Yeah, and so it's all in how much you want to get involved in it. And so buying a private business is no joke. It's time consuming. It's you got to know what you're doing. Um, Buying public companies is you don't need to know as much. And so, I talk to people about this all the time. It's like, how much do you want to be involved? And some people want to, like myself, I mean, they want to be involved with everything. And then we got people all the way down to the people that just want to contribute every weekly paycheck to something. And so I think, people, it's important to understand their investor ID. What are they willing to do? Because one of the things I see a lot, and I even get into this, is I quit I quit a 60 to 100 hour a week job to do a 60 to 100 hour a week business. And the difference is I'm taking on all the risk now. And so I see people with these visions of starting a business and that everything's going to be, hunky dory, and we're going to be able to travel and we're going to be able to have our life. And they have no idea what they're getting into when they buy businesses, and they're really buying a job. And so it's really important to understand that, uh, make sure you know what you're getting into and that you're ready for it. And so I don't want to sway anybody one way, but my coaching would be figure out what you want and what you're willing to do to get it. And for some people, buying a business might be the right endeavor. For the other person, investing in the public indexes or stocks or something like that might align with their ID.
So what are some of the biggest risks of investing in private companies people should be aware of?
Liquidity. Oh, let me rephrase that. Illiquidity. Like they're hard to move, and um, most of them, especially entry level businesses, is you're going to be in the business. Um, and those smaller businesses, in my opinion, are all overvalued because they value typically on owners compensation, which is not, the owner's still in the business, and so they're an employee. Knowing how to interpret the data, right? So a lot of the data that you're going to get is going to be skewed one way or another depending on whatever the person that's trying to sell it wants to present. One thing I've learned in the valuation industry is nobody knows. Like I, I was like, when I first started, I was like, oh my God, what's the value? And I'm working with like where I actually worked for one of the founding, I call them the founding fathers of valuation. I read their books when I first started, and I got to work in their right next to them in their office. And it's like they tell me, they're like, hey, Zach, no one knows. This is our best judgment based on the interpretation of the facts. And there's different values for different people. Like there's investment value as opposed to fair market value. For example, if I need a strategic piece of software and you own that software, I'm going to pay more than the average market buyer would. And so, if you're going to buy a business, get a broker that knows what they're doing. There's tons of great brokers out there, tons of great professionals. Make sure you have a finance team that you understand the tax consequences and the good stuff too. But there's always a tax consequence to every decision. Make sure you have a great legal team that really make sure that you get the value of the company. And what I mean by that is maybe there's intellectual property rights, or maybe there's a customer list, or an intangible asset that might not be conveyed. And so like little stuff like that, I mean, it could change everything.
So yeah, and I guess the logical question is that's great having all those things, but what about somebody who's doing this for the first time? How do they go about this? I mean, one of the challenges you find with service professionals is you can't tell if they're competent. You're buying a product,
Right.
you're like, oh, it's a product. It has ratings. Everybody's bought this product. It's the same. You're buying like an attorney. Like if I'm looking for an attorney, I don't know if they're any good. I'm only going to know after the fact. So how do you go about
Right.
that process of putting together a whole team with all these different skill sets and know that you're picking the right people?
I would say, that's so true because, I've learned the hard way many times. And here's what I would say, get educated. And so if, I'm educated enough to know if someone knows what they're doing, right? From a CPA standpoint, from an attorney standpoint, uh, I'm not by any means going to act as one of those, but I do my research to know to know what type of questions to ask, what type of direction we should be going down. And so if you're not willing to educate yourself, I would say don't even get in the arena because I mean, there's days on the regular where I have disagreements with CPAs and tax attorneys and regular attorneys, and I feel I'm in the right, and then I go talk to someone else and I am in the right. But like you said, you don't know unless you know. And then I surround myself with people that are doing this. I have communities of people. There's programs out there, there's networking, there's mastermind events. In my opinion, it's worth the cost of admission for the good ones, just to understand what questions to ask, right? Which people are good and which people are I don't want to say not good, but incompetent maybe is the right word, like you said. Yeah.
Okay. Um, so, do you recommend this strategy to everybody? Because I know in my experience, most people just they want a point and click kind of a solution. So, what do you recommend for like the average investor?
So I would recommend average investor passively if work with a team of professionals unless you want to be in the day-to-day of it. And I know we were talking in the green room is one of the things I see, and I've been doing this for 20 years, is people don't respect what it actually takes to make money as a business owner, as an investor, as a financial advisor. There is so much that goes into that, from interpreting market data to economics to the human side of things to the tax implications of things to the uh, even auditing, like, are we looking at right information? And so unless you're like really getting into that type of weeds, my suggestion would be the traditional stock market, the traditional retirement plans with the traditional people guiding them, because jumping into this world, I've seen people lose their fortunes thinking that they could drive that bus themselves, and it's a much bigger bus than I think anyone knows.
Yeah, no, I couldn't agree more. Um, so I want to, as we in the interest of time, we got to wrap it up. But one more question for you before we do that is, a lot's changed in the last, since 2021 or in the last 24 years. The the economy is different. Things are different in large part. How are you thinking about that? How are you thinking about the change in the economy and how it impacts, like, small businesses compared to, let's say, the public markets?
So for me, it's like the word that comes to my mind is trust. Specifically, we do all of our businesses are online. We have, we don't have them, we're not brick and mortar. And so obviously the trust of people online, that's sort of just a nature given Amazon, right? You can buy it. So people trust buying online. And so now they have to trust that you can actually do what you say, you're actually who you are. And so one of our business models is we build communities, and we give tons of free training away. And we ask questions, we provide great value add before we even ask for their business. And so we gain the trust of the consumer, because right now there's a lot of not trusting out there. And so I mean that model is just it's done so well on all of our businesses, given that we're in the service industry, right? Or service industries. And so that's what we're taking, that's how we're hitting this on, is just creating a community that knows, likes, and trusts us. We use marketing dollars to get people into our community to forge that relationship. And then it's a lifelong relationship, but you got to know your numbers, right? It boils down to you got to know the math and what you can pay to get those people in there and how long it takes to convert, and all of this other complicated stuff. But that's the way we're taking it on.
Okay, makes sense. Well, we got to wrap it up here, but Zach, appreciate you coming on the show. And where can people find more about you?
Yeah, so I got a couple of websites. Indiana Oehlman is my blog. I love talking about finance and theoretical conversations of business and our travel. So indianaoehlman.com, valleyinvestmentclub.com is our real estate stuff. And then Elevate with a VA is our business development. Elevatewithava.com is our business development VA staffing. And so that's sort of encompasses all of this stuff we talked about today.
Nice. Great. Well, Zach, thanks for coming on the show. And yeah, we'll probably have you back in the future, as I think this field is going to get a lot more popular in the next few years if the economy continues to stutter.
Yes, that's a great way to put it. Well, thanks for having me on, Kirk.
All right. Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today. All right. Well, that was a great interview with Zach. Really appreciate him coming on the show. Now we're into the panel portion of the show. We have our very own Barb Friedberg. Hey, Barb.
Good morning, everybody.
Glad to have you. And we also have our very own Megan Gorman. Hey, Megan.
Hi, Kirk. How you doing today?
Doing great. Can't seem to get this line off my face from the video, but I'm otherwise I'm doing great. Well, cool. So let's just dive right in. So Barb, what were some of your takeaways from the interview?
I think my main takeaway, and I'm going to use this really broadly, is we've got to kind of think about valuations, and I'm going to take this to the markets. You want to think about how the market is valued now. You want to think about how your individual stock holdings are valued now. And then what does that mean for your investment portfolio? And so I'm not going to answer the question, but fully, because then I'd be usurping the entire time. But I think that's a topic we should get into. How is the market valued? Is it overvalued? Is it undervalued? Does that mean we should deploy more or less capital? Where's the market going to be? So I'd like to talk about those type of questions today, Kirk and Megan.
Absolutely. Let's dive right in. Megan, what about you? What are some of your takeaways?
Yeah, I mean, I think that, like Barb, I think valuation is probably where we should talk about. And I think, one of the things that he touched on a bit was process. I think he's very process driven in how he works with people and how he handles real estate. And I think that process is important in all aspects of investing, right? And so as we're sitting here at the beginning of the year, what it also made me think about was setting client expectations and making sure the investment mandate for a portfolio is set appropriately for the year ahead. And I think that ties into what Barb's talking about with valuation. So a lot of the work I've been doing with clients this quarter has been going through their investment policy statements, talking to them about how, they felt about last year, how do they want to be handling things, and then looking at data points. Because from where we were 12 months ago to today, it's a completely different market, not just in equities, but in fixed income and cash as well. And so that's changed people's perspectives on, what should they be doing. But I think we all have to stay relatively grounded here, that despite having a great January, we are not out of the woods yet. And so really working through expectations of what we want to do over the next year is really important.
Yeah, so let's dive right into that, because we've had a really interesting start to the year where the markets have pretty much just gone straight up. So Barb, what are your thoughts for the year so far, and kind of where we've gone, and kind of what are your expectations going forward?
Well, a lot of it gets down to your asset allocation. And what that means is your mix between stocks, bonds, cash, and any other assets you might have, like real estate, commodities, whatever, alternatives, that sort of thing. And 90% of your long-term returns are not based on your individual holdings, your individual stocks, bonds, whatever. They're based on your asset allocation. And what that means is stocks typically over long periods of time have higher returns than bonds. Cash typically has lower. Just to throw out some geeky numbers, over the past 100 years, stocks have returned approximately 9% per year. Now, obviously, there's some years like last year where they fell double digits. But if you average it out, you average out, bonds in general have earned about 5% a year over the past 100 years, cash about 3%. And the reasons that stocks are higher is because they're riskier. They have the possibility of going down quite a bit in one year, as we've all seen. And asset allocation matters because if you're younger, and if you have a lot of time and a lot of income to make up losses, then you can afford to have a riskier asset allocation, like a stock-heavy portfolio. Valuations matter because if stocks are overvalued, at some point, they're going to come back to their fair value. Now, maybe years, and that's what happened. Going up to 2022, is there were many, many, many years where stocks were on paper very overvalued, but they didn't come down to near fair value. And I'd like to argue stocks are still even a little overvalued by historical metrics. But does that mean next year, this year, we're due for another fall? Well, maybe. But you need to, and I really love what Megan said, you need to take a few minutes, sit down with yourself, with your financial advisor, and you have to say, okay, am I in the right asset allocation? And this is the perfect time to do that, because last year, you can decide, how did you react last year when stocks fell that much? Were you clearly able to handle that without having any knee-jerk reactions, without selling at the bottom? Because if you were, you're probably in the right asset allocation. But if you thought, like, I experienced way too many losses last year, this was too much for me, I may have even done something stupid like sell at the bottom, then you've got to realize that you might need a little bit more fixed or bond or cash in your portfolio.
Yeah, but Barb, that's crazy talk. I mean, the markets went down and now you want to reallocate. Shouldn't I just buy and hold and wait till it goes back up to the top before I make changes?
Oh my gosh, I love that you said that. That is like one of the biggest psychological misnomers in investing, is that we can't sell, we have to wait to get even. And to counteract that, the best answer is you have to figure out not anything about the past with your investments, but what are their prospects for the future. Getting even is irrelevant. Look, sometimes we have losses, sunk costs. You're not going to get the money back by wishing it so or by waiting, but by looking at, where am I today? Am I in the right asset mix, regardless of what I lost last year?
Okay, cool. Well, I appreciate that, Barb. Megan, what
Oh,
about you?
sure. Anytime.
Yeah, I mean, I'm going to continue on the path of IPSs just because of what Barb said. I think that one of the things that we have in IPS is sort of the breakout of what is the target allocation. So we talk about asset allocation all the time, but one of the things that I think most investors don't get a chance to do unless they're working with an advisor is see where their allocation is versus the target, right? And that's really important to do with all of your accounts. So just because you work with an advisor and you have accounts with them, you might also have a 401k or you have a 403b or a pension somewhere. All of it has to be factored in. And I think it's really important to look today at where your targets are, because even if they're out of whack by like 1 or 2%, it forces you to think through, am I properly allocated? And I think this is a good time of year to do that, because it also gives you a chance to think about what other cash withdrawals you have this year and what is your tax situation for 2023. I had a lot of clients book significant losses last year to use in future years, but it also, having losses gives us flexibility to shift a portfolio around. So that's some of the work I'm doing with IPS statements, which I think is valuable in a market like this. But I also think it's really important to stay focused on the long game. This market will change. It feels like it'll take forever to change, but it actually will be quicker than we expect.
Okay, cool. So I also wanted to bring up a bit of news that happened last week or two. Jeremy Grantham came out with a comment that he thinks the market's going to drop like 17% from here. I think it was 17. Either way, it's a lot more than we are now. And I think it's going to throw a lot of people for a loop. So, that brings up the concept of valuations. I mean, his firm is well known in the institutional side as being really good at determining valuations of the market. They're also really well known for being early in their calls, but regardless, that's a totally different point. So Barb, getting to you, like when you're looking at valuing a market, I mean, the market's dropped 20%. Isn't the market cheap now? It's down 20%. Can't we just buy and make lots of money because it's down 20? Like, how do you look at valuation?
I look at valuation if in the simplest way by the price divided by the earnings. Now, obviously, I look at, and analysts look at a lot of other ratios, but the price of a stock or the price of an index divided by their aggregate earnings is going to give you a number. For example, the S&P 500 divided by their earnings typically will give you a number between, 10 and 70. The long-term average PE ratio is 15. Now, we are not down to 15 now. I'm not sure where we're at. I was trying to pull that up, but then I'm looking down at the ground and I can't do two things at once. But I think we're still around the high teens for the valuation. So if you're looking at the average of the past 90 years and the PE ratio of the S&P 500, Standard & Poor's 500, which is frequently used as a metric for the entire stock market, is at 15, is at, 20 or above 15, that's suggesting that according to history, and look, things may change in the future. We don't know, but we may be overvalued.
It's 21.7 for reference.
Thank you, Kirk. Thank you. Yeah. So I was close, but I was even low. 21.7. That's a high PE ratio. So that, in combination with Jeremy Grantham, which is, a very, very savvy and smart money investment manager, gives the indication that, yeah, we definitely might be in for another stock market fall should the market lean towards fair value. But the reality is it doesn't always do that. And I'm going to turn that broken record on again, because if you have 80% in stocks and 20% in cash and fixed income, if the stock market falls another 17%, are you going to be comfortable with 80% of your investments dropping that 20%? Now, if you're not, then you might want to kind of lighten up on stocks, put a little extra cash or bonds in your portfolio, and risk losses in potential returns should the stock market outperform this year, but also cushion yourself from those huge drops should they materialize. So we don't know the future. Even if the stock market is overvalued, it doesn't mean it's going to return to fair value this year, next year, whenever.
Well, I'm going to make a prediction, Barb. My prediction is the market could go up 30% this year. It could go down 20% this year. How about that? Is that a good prediction?
Okay, I'm going to hold you to that.
We're going to remind you said that.
Or somewhere in between.
Yeah, we're going to hold you to that, Kirk. And if the market goes up 30%, well, you're going to be right. If it goes down 20, you're going to be right.
Yeah, I make this in jest because I think what's interesting, and if you look at the year end, the future year prognostications that Wall Street comes out with, everybody throws out their opinions, and a week later, everyone forgets that they ever said it. And at the end of the year, they look, oh, look, I was right. That 1 out of 20 I got right. Look at this. I'm awesome. And they just totally like erase the other ones that they made. This is like one of the secrets of Wall Street. And I mention it just to kind of point it out. It's like, yeah, my predictions, the market's going to go up or down or sideways, not necessarily in that order. We don't know what the market's going to do. And we point this out because we're trying to give you guidance on how to think about the market, which I know may be making things more confusing. But if you have a system that you follow, which, as Barb said, PE, okay, I don't use PE, Barb uses PE. Everyone's got a different system. It doesn't matter what our system is, as long as it's a system that you feel comfortable with, that makes sense to you, right? So if you look at historical PEs, I actually pulled it up while Barb was talking. Since she can't walk and chew gum, I can, because I wasn't talking. But right now it's 21.7, and one as high as 123, one as low as 5. Of course, 5 was back in the 1917. But if you look at, we talk a lot about the 70s being kind of a similar time frame. That was right around 7 to 20. Like that was the range in that period. And what's the range going to be in the next 10 years? I have no idea. But I know that if you look at historically, as Barb said, we are still pretty expensive. And I think this is the thing that a lot of people don't get. The market sold off big time last year, trying to channel my inner Trump big time. But, if you look at the history, of the markets, we are still above where we were in prior to COVID in February of 2020. We're still above that in price. And yet the economy in many ways has gotten worse, not in every way. Some companies have continued to grow, but we were overvalued then. A lot of institutional research people were talking about how it was overvalued prior to COVID, and then we had COVID. So how is it still more expensive as a whole? So it's just things to think about. I'm not saying that's right or wrong way to look at it, but it's a different perspective that you can bring to the table when you're thinking about it and saying, well, I think the market's going to go back up. Oh, really? It's going to go back up to all-time highs with interest rates at, close to 5%. Okay. Go with that, right? That's not my thesis, but if that works for you, go with it. But at least understand how to think about it and understand the different lenses you can look at your portfolio and the economy with when you're making these decisions. So Megan, I know you kind of take a little different perspective. So what's your perspective on the markets and where you think things are going?
Yeah, first of all, I think for all investors, January was a little bit of a relief, right? We'd been taking a beating since November of 2021. So to see everything in positive territory felt good, but we are not through this yet, right? And so, one of the things that's very striking when you look at the data from 2022 is there were 219 trading days where the S&P moved intraday up or down more than 1%. So we had tremendous volatility last year. And just because we're in a new year doesn't mean it's going to go away. So, Jeremy Grantham saying that it could drop another 17%, it could, right? I think the expectation has to be that volatility is going to be here for a significant period of time. We have a lot to work through. And part of it is, we're not in a structural recession. We're in a mix of a cyclical and event-driven recession. right? You've got the cyclical factors like inflation, interest rates changing, and then you've got the Russia-Ukraine situation, China, all those different pieces at play. So at some point, what we have to keep in mind is the market will trough, right? And when we've looked at past recessions, the market has troughed at different points, depending on it. You know, on average, the typical recession's 14 months and the typical expansion's 47 months, but that doesn't mean that's going to happen this time. So as you know, we've been navigating this, right? I have a lot of clients who are sitting on cash, who have, you know, excess income coming in, and they're looking to figure out what to do. And sort of we're going in sort of two different directions in sort of dealing with this volatility. One is people are saying, look, let's keep it simple. Let's stick with the risk-free rate of return and doing a money market fund and earning 4.5% and taking on limited risk. I understand that point of view, right? It feels good. And it also feels good because cash hasn't had yield for a while, and we don't know how long this will last. For my other clients, a lot of them feel like, look, I've been here before, I've done this before, I get how volatility works, but I believe in the economy. And so what we're doing with a lot of them is building out dollar cost averaging plans that maybe monthly or quarterly they're deploying into their portfolio with the understanding that in the short term it's going to be painful, but they hope that they're rewarded for their patience over the long term. So, you know, it's going to be a hard year in the market. This is not going to be one of those great years where it's very easy to see what's going to happen. But again, a lot can happen over the next 11 months, and we need to be patient. And so, you know, having sort of a strategy of how you want to be in the market and sort of tune out the noise, because the last thing I'll say is any article that has a quote like that, or any TV show on the financial news that has somebody, a talking head talking in that manner, you have to remember they're looking for either headline clicks or people to watch the show. And they don't watch the show with the boring investing advice. Nobody wants to hear that the best investing is like watching paint dry. You can't get ratings for that, and you can't get clicks for that. But again, reasonable expectations this year, and just, you know, continue to build out your portfolio.
Well, that would explain why they invited Warren Buffett on CNBC, and then the interviewer.
He's a little different. He's an icon. When you can get an icon on your show, you get an icon on your show.
Well, what I was going to say was they invited Warren Buffett on the show, and the anchor talked over Warren the whole time, giving Warren his investment advice, as if Warren needed that from a guy who has no experience and never managed money. So, to me, I always find that show amusing, if nothing else. And maybe the only person watching it, but anyway. All right. Well, as we kind of wrap it up here, so Barb, what are some final thoughts you can leave the listeners with, you know, for investing advice?
I'm going to piggyback on one thing Megan said, which is dollar cost averaging. And what that means is you put a small amount of money into your chosen investment portfolio at regular intervals. Surprise, if you have a 401k, that's happening every time you get paid. A certain amount is going into your designated investment mix. And that's very smart, because over the long term, you're going to buy more shares when prices are down and fewer shares when prices are up, automatically systematizing buying low. So that's a good thing. Another thing I'm going to catapult off of Kirk is turn the news off. I'm typically an index fund ETF advisor now. Decades ago, I was a stock picker. I have still held on to a couple of individual stocks that I feel have really good growth prospects. I was looking at one of them last week. It was a healthcare stock, and the projection was, oh, this isn't going to do very well. There are other companies that are better. I've got a hold. I've got a sell rating. And I looked at the figures and I said, well, you know, it may not be the most fabulous healthcare stock out there, but it's steady. It's got a good product. It's gotten a lot of adoption. I'm going to hold with it, even though the outlook was kind of gloomy. Today in my feed, the company reported outsized earnings, and everyone's like, oh, I love this stock, blah, 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 blah. If I had jumped on the neutral to negative news and sold it a week or two ago, I would have missed out on this. So you've got to be really cautious with making knee-jerk reactions based on one guy or one gal's opinion. And if you are going to own individual stocks, you need to understand what is making that stock grow tomorrow. And will those factors continue? So I am Barbara Friedberg. You can find me on RoboAdvisor Pros, YouTube, and at Barbara Friedberg Personal Finance.
Thanks for coming on, Barb. Megan, final thoughts from you?
Yeah, I mean, I consistently say best investing is like watching paint dry, and people want to do something in these markets. So the three things, as I sort of talked about today, that I would do is, one, take your investment policy statement out, review it for the year, think about what it's saying in terms of asset allocation, withdrawals, tax rates, all of those different pieces. And then two, compare it to your asset allocation. Are you on target? Are you underweight in one asset class, overweight in another? And see what tweaks you might want to make to get yourself back on target. And then third, dollar cost average. And as Barb pointed out, it can be in your 401k, but you should have money going to work on a regular basis into the market with the idea that you're thinking about your future self, and that person you're going to be in 5, 10, 15, 20 years will appreciate you buying today. So I'm Megan Gorman. You can find me at Forbes.com. Kirk, thanks for having me on.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.